Hello, it is the 19th of December 2010, and I'm going to take a little break from silver in this particular video and go over the gold technical analysis. And I have a lot to go over in this video, a lot of different tips, whether it's for day trading, long-term trading, entry points, short positions, or selling points, that sort of deal. Go over different stop loss strategies. We'll have some fun today. And we'll start with the intermediate term or short term, depending on how you look at it. This is intermediate term as far as I'm concerned, which is a month, maybe a couple of months. And it's been in a uptrend, and it's been consolidating throughout this time wave pattern, roughly between the 1325 and 1425 variables. When you look at a chart and you don't see anything that happened before here, you can see these moving averages, especially this 50, and say, okay, this 50 is rising. So what does this tell us for what happened before the 31st of August? Well, since it's rising as it has, it's been in a bullish uptrend. Of course, people who have been following the market, they already know this anyway. And that can be important so that you know when you're deciding to do what's the trend telling us. And the trend's telling us that it is going higher. So the question is, we came back down to this 50-day moving average. It consolidated. It is now breaking away from this point. If you were to be playing on this, there relatively is three different ways of doing it. Number one is you buy on the breakout of this level, which pretty much was at the end of the day. It's a little risky. It wouldn't be my favorite. If that's the case, you stick your stuff below this line in here. Another way is to find the pattern start to change, where you want to develop a higher low and then start to break out. For example, you come up, maybe you come back down here, and then as you're going higher, that's where you could get into an entry position. We'll talk more about that later on this episode. And another one is fishing for a bottom, calling a bottom, if you will. And they might say that calling tops and bottoms is that of a fool's game. And I'd have to disagree and state it is a Fibonacci game. And where would you have bought? Well, maybe here. And I really have to emphasize maybe, because the level that it hit on an intraday mark from the highest point in here to the lowest point of this range was around 10 cents above the 38.2% Fibonacci. So if you were waiting for a market order to go long when it hit Fibonacci, you were close, but it never happened. And I made a video recently, well, I don't know about recently, almost about a month ago, and I was stating, okay, silver's at 25. It's at a Fibonacci level that is expected to be support. Now, I don't like the linear Fibonacci, but I realize many people look at it, which is the reason why I took the exception for it. It was the Fibonacci from the 29 and 1/3 highs at the time and the lows of, or the breakout lows of 18. It was also at the area where it was at the 20-day moving average, and it was the previous major last resistance. So there's many different things that came into play. If that's the case, and you state, okay, I'm going to play because it's at Fibonacci. Question is, how much risk are you going to take? Because if the Fibonacci fails, it can be very, very damaging, and a lot of times increase its volatility. Now, in this case, this was a perfect bottom. It's obviously now at $29 an ounce for the silver market right now. And now we're going to move on to the longer term time frame. And this is a Fibonacci line chart. In August of 1993, silver hit $410 an ounce. In 1996, it managed to hit a double top and hit, or at least pierce this top again, and then hit a low here of 251.70. The higher low came in here, and thus we established a Fibonacci range of 251.70 and 410. Therefore, all these Fibonacci levels are now set. The 160.18 level, well, it bursted through this level, as you can see, big time. Then on the 666.13 level, it found resistance, managed to find a higher low. And that's big because you find resistance. That doesn't mean it's going to top there permanently, but it does mean that there's a good chance something like this would come into play. And it finds resistance at this level. Then it goes right up to the 922 mark. It pierces above it, and then it sells off. Comes back, and it plays around with it again. Breaks it out in here. Has a fast move up to this level, which is where we're at now, which is the 685.4%, 1336. And when a Fibonacci level gets violated, and it's not resistance, or it's not support on the way down, then you would expect a big move to the next one. Sort of like here. You're supposed to find resistance here. It did not happen. Therefore, you had a fast move up to the next one. So what I'm trying to say here is, if there's not much resistance here, you could very easily expect a fast move up towards this level. So now what we'll do with this chart is go over some entry or exit positions within the market. Therefore, when would it have been right to short this market going lower? Well, you'd want to know what happened before. And there's no moving averages on here, so you can't use that example. But it was in a downtrend. 1980 silver was 800 somewhere up here, and it fell lower, so it was in a downtrend. And this entry points is, okay, maybe you see this higher low, and then you get in somewhere in here. As far as where a short would be covered, well, you'd make a higher high in here. Every single time you were looking to buy in the late 1990s, there really wasn't any opportunities to. Say, for example, here, okay, you have a nice high. What you want to see at this point is you want to see it stabilize and break this high. This is where it did not break the high. So therefore, where was the first opportunity? Well, here you had a breakout. So now what you want to be able to do is establish a higher low and then make that higher high. That never happened. You never made this higher high. The pattern still continued to be very bearish. You hit this double bottom pattern in here, and now you had established a resistance level for the market. And the resistance level is somewhere roughly around here. Let me just do the line a bit better. Maybe make it even smaller too. There. Okay, so the resistance line would be somewhere like that. So now when we take a look at this chart, we can see it got above it here. It found support. So where to break it out? Right in here. That's a statement stating you might want to go long. And was it successful? Well, obviously it was. And the next one was you found this resistance point in here. You stopped, you went below it, now you came above it. You want to find support, and that's exactly what you did. So the entry point right somewhere in above here. And that obviously was successful. Now, if you're playing the Fibonacci in here, this means that you sell here. That worked out pretty good. And that's why if you do anything like that, buy or short on a Fibonacci level, where's your stop going to be? Okay, so it's going to hit 507.83. That's where I want to short. Well, where's your stop? Is it going to be 540, 550? Because if that's the case, you needed it at this point. And if you use this to sell a little bit, well, when did you get back into the market? Because if you have this big gain that we have been having, a lot of times you don't want to buy when it's up so much. You want it to consolidate either through time or through price. and it never happened, and you sure as heck are not going to be buying when it hits this Fibonacci level. So when was the time to buy? Well, you hit this resistance, you made a higher low, and you're back at this point. The breakout in between here seems to be the most effective buying opportunity. Now, had you have sold or shorted here, this one was very, very successful because of the fact that it obviously went much lower. Now, this is a close-only chart. So on the May '06 highs, it looks like it hit 666.13. That was really incorrect. It hit like 700 and something, 730, I think. So when this low came back down, when this low came down to 700, it was pretty much at this former level of resistance. And if you were to go there, or if you were to buy at this point, you'd be buying on the way down. You pretty much would be calling a bottom. And on a fundamental level, you could say that's the case. But also in a technical mark, when you have a big gain, at some point you need to establish some sort of support. And it was needed here. It's also needed right now. It doesn't have to happen now, but if it keeps going higher, it's still going to need to establish support at some level. And thus, it did establish nice support here at the 700 mark. And by using the same sort of principles, you had this Fibonacci mark here, a breakout here, would have been another good long opportunity. So now the question is, what do we do now? Well, obviously, if you can make a pattern where it does something like this, there you go. Now you are seeing that the market is going to change over because we're at a point now where the market's telling us, hey, wait a second, it's supposed to top here. It's already pierced above it, which quite frankly is pretty bullish that that's the case. And if there's not much resistance, whether it be a correction through price like this, or there's not even a time correction, which is something like this, a time correction, then it's just going to burst towards the upside big time. And it probably would happen in, let's see, 4 months, 3 months, maybe 6. That's relatively very quick to have the move. In fact, when it broke this Fibonacci level, this was December '05, and the next one was May of '06. So that was about a half a year when it went from this one towards this one. Also, may I point out that this chart goes to 2013. And if people are talking about gold going to 5,000 and maybe even higher than that in the next so many years, it's going to have to get really, really parabolic, because this 2,000 price target, generally speaking, should be like early 2012. And that would maybe something like maybe in the area of something like this, so that by the time we get to 2013, it would be about 1800. Now, if the fundamentals of the market and the fiat currencies really explode like it most likely is looking like it would or will, then there will be another stage of parabolia within the market. I'll explain that later this week when I talk about I think it's the 4 stages of silver. We're currently on stage number 2. And I'll go over that later on, showing that stage 3 and 4 is extremely parabolic. And gold would also share the same stages. So what we'll do now is talk about multiple Fibonacci's, because if you are looking to be buying on a spot of Fibonacci, let's just say, for example, that the markets go lower, then if you take the 38.2% from here to here, then that would be an area that has the likelihood of, I don't know what the percents would be, 75%, 80% of finding a bottom. And what kind of bottom? Well, that would be a bottom right here. Because if you were to make a trade here, then there should have been some profit taking up here, or at least you stop for a profit and up towards this area here. So the likelihood, if it were to do something like that, and I'm just saying this for any type of example, because whether you're trading gold, silver, crude oil, the Japanese yen versus some other currency, or anything like that, the Fibonacci seems to work out very, very well. But there's another Fibonacci level that I want to go over. And that's within this chart here. What we'll do is we will take the lows from 2000 or from 1990 at 251 and the highs of 730.08. So these highs would be right in here. This would be the high, and then the lows in here. Now the 161.8% Fibonacci on this calculation is 1025.74. Where did the market top in 2008? The answer was 1029. Therefore, it was 3.25, only 3.25 above what that level was. So if you're saying, okay, I want a short at 1025, I got to short that level. And if you did, you would have picked the top pretty much as perfectly as you could have and had a nice gain. If you were long on the market and you said, okay, I'm going to stop buying or I'm going to sell a little bit, once again, you would have sold your gold at 1,000 and then bought again below 825, 825, 800, all the way down to 700. Therefore, you would have got the prices cheaper again. Now, within this chart, we obviously had this rectangle pattern, and I mentioned before that a lot of times you might want to wait for support to happen. In this case, it never did come into play because it never came back to that 1029 mark. And therefore, if that's the case, then maybe you got in on this move above this break of this resistance line. That all depends on your trading style. Now, to finish this off, I want to go over an interesting little trend line. And what we'll do is we will take the trend line and we will connect these points in here. That you know what? It's really just trying to. Everyone draws these differently, so to say that these are precise lines would be far-fetched. So we'll do something like that, and then we'll draw another one of the same variable rise. And what we'll do is we'll stick it into the support level, and then we'll do it again. And this will give us our current trend within the gold market. Something like that. I drew this better on the previous charts. Let me just bring that back up. Okay, sorry about that. That was a video by Stella Concepts. Didn't mean to do that. I wanted to bring this back up. Let me try this again. I was doing this yesterday and it came really good. So let me just try it again. We'll get a different color. Okay, so we got a... that's not how I want to do it. Okay, so we have this uptrend line. We'll copy it again, move it lower. We'll draw the support level. And then we'll draw it again. This is the trend that I'm looking at. It has three different lines, a resistance line, a support line, and a neutral line. Right now, it is riding the neutral area within this parabolic uptrend. And when this is the case, there is no reason to consider this in a bubble. In fact, if you got the fundamentals for it, then great. I don't see fundamentals to say a bubble. And on a technical level, it's got to break below this line and obviously show that the patterns are going to change before you can call it a bubble right now. Therefore, where this line is right now is pretty much about this little area here, and that's roughly at about 1150. So that's the big support level ish or so. If we have any more, if we have any big selling that comes within the market. So this has been a long video, 20 minutes, and I knew it was going to be long because there's a lot of great information to go over. And thank you all for watching and supporting this channel, and have yourself a great holiday week. Bye-bye, everyone. And one quick little piece of information before I go that I had forgotten, which I said was stop losses, and that is, let's assume that you bought on this breakout here. Where would your stop be? The answer is maybe below this line here. And as it keeps going higher, you raise your stop. So when it hit this low, your stop wasn't violated. Then it broke this resistance and kept going higher. So where's your new stop? Below this line. It goes up here, you adjust your stop in here, you adjust your stop, you adjust your stop, and then you have this parabolic gain. If you're here and your stop loss is here, there is something wrong. Maybe you do the 38.2% from this bottom and top, or maybe even 61.8% if you want to take some more chances. Either way, they never got violated. So you had this range in here and you started to break out. Where's your new stop? It is below this line. Just like in here, when you had this gain above here, then you needed to say, okay, where's my stop going to be? And during this selling here, at some point, some of your positions should have been just taken away from the market because you would have been violated. Maybe it was below this line in here, and if that's the case, well, you should have been buying here on the fundamental basis just because it was really down too much. I know a lot of times you don't want to buy in a bear market, but when you realize that you're an upward trend, you realize what the currency is doing, for the most part, it is a very successful play. Therefore, as it's going higher again, where's your stop going to be? Well, in here, you would probably be doing the 38.2 or 61.8 from this low to this high. Very successful. As it goes up higher, your stop's now below here. You have this gain, you go below here and higher, so now your stop went below here. You have this low, and right now you're here. Therefore, if you're currently trading, where's your stop? It's below this line right now. If you manage to have some gains like this, well, then your stop would obviously keep going higher as the market keeps going higher in coordinates with the price action. So just wanted to point that out because I wanted to explain that and I totally forgot that on the first 20 minutes. So thank you again for watching. Take care.